A very warm welcome, everyone. My name is Nicholas Tan from Kenanga Futures, Sdn Bhd. Thank you for spending your precious time to join our webinar today. And it's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to all the participants here. So please take note also that futures and option tradings involve substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes, and Kenanga Futures Sdn Bhd accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. Today, we have Mr. David Gibbs here, and he's going to share with us how and why it is important to trade US index futures. So, without delay, I would like to kickstart our webinar by welcoming our speaker today, Mr. Gibbs.
Thank you, Nicholas, and welcome everyone. On behalf of CME Group, I'd like to thank you all for joining the webinar today, and again, my apologies also for the technical delays. Thank you for staying with us and joining the presentation today. We're going to be talking about a very important asset class at CME Group, equity index futures, and it couldn't be more timely to be having this discussion, as I'm sure you're all very much aware. The markets in the last 2 weeks have been incredibly volatile, stock market in particular. The US stock market, as measured by the S&P 500, has backed off approximately 10% off of its highs from a couple of weeks ago. So to be looking at this product today is absolutely current and timely. So let's just jump right into the details. What we're going to be considering today are 3 of the major benchmark stock indices futures that are traded through CME Group's electronic platform, Globex. And it might be useful to give you a little backstory about how these index products came about, what they mean, who trades them, and why. Stock index futures were relatively new in terms of financial futures. The original financial futures were currency futures introduced in the early 1970s. By the mid-1970s and the early 1980s, interest rate futures were developed. And then finally, index futures or futures on equity index products were launched in 1982. CME Group was not the first exchange to list equity index futures. The first equity index futures contract was listed at a small regional exchange in the United States called the Kansas City Board of Trade, and it was based on an index called the Value Line Index. It was launched in February of 1982, and you would have thought, because the industry was anxious and looking forward to having these equity index products, that the first product itself would become the leader in the space, but it didn't. In fact, many of you have probably never heard of the Value Line Index, and certainly not the Kansas City Board of Trade. Both the product itself is gone, and the exchange is gone. CME bought what remained of the Kansas City Board of Trade 4 years ago. The reason that that contract never took off, the Value Line Index futures never took off, and subsequently, 3 months later, when CME Group or when Chicago Mercantile Exchange launched futures on the S&P 500, and it did take off, it took off in a big way, has to do with a very simple word. It's called benchmarking. And as you can see, this illustration on the slide is meant to be a metaphor. Benchmarking is how professional risk managers measure themselves against each other and against the marketplace. The S&P 500 is by far and away, at least for the US stock market, the benchmark by which market professionals measure themselves. We're going to talk about a couple of other benchmark indices today as well, but benchmarking is the key to this whole concept of index futures products. We're going to explore that a little more deeply over the next hour, and at the end of the session be able to take your questions about these products. But it's the idea that the risk managers use these products to measure themselves that we're going to focus on. And it's not just in the US. This is a global phenomena. After the early development in the 1980s, futures exchanges around the world also began to list regional benchmark indices on stocks. Certainly within Europe, the FTSE 100, the CAC 40, and the DAX are highly recognized regional benchmarks. In Asia, the Hang Seng, the Nikkei 225, and other indices are also recognized regionally as regional benchmarks. The Nikkei 225, in fact, has futures contracts listed on 3 separate exchanges. The exchange in Singapore, the Osaka, and we have 2 Nikkei 225 contracts listed at CME. Even in emerging market economies like India and South America, there are equity index futures contracts, all tracking what would be national or regional benchmarks. In fact, when the World Federation of Exchanges does its annual survey of its, and this last year's survey included, I believe, 48 different futures exchanges, the product line that was the most heavily traded were contracts on stock index futures. This is a graphic from that report showing you the numbers of contracts traded in millions at regional exchanges just in stock index futures or equity index futures. CME is at the top of that list because the US stock market is the most heavily capitalized and the most heavily traded, and we have most of the benchmark indexes on those products. But you can see without question enormous contributions from around the world. This is now a globally recognized asset class and is the most heavily traded of all futures contracts. Let's start looking at the various indexes available to you through CME's Globex platform. Probably the oldest and the most recognized index of US stocks is the Dow Jones Industrial Average, or DJIA, sometimes just referred to as the Dow. This chart, and I don't know if you can see the x-axis at the bottom, goes all the way back to 1915, actually 1913, right about the time of the First World War and the foundation of the U.S. Federal Reserve Bank. The Dow is a very, very old contract. I call it the granddaddy of stock index futures. It actually has its foundations back in 1896. It's very old. It's been around for a long time. And in fact, just this year, General Electric, which has its foundations founded in the 19th century by Thomas Edison, was the last of the original Dow members to fall out of the index. The Dow Jones Industrial Average, as we're going to see, is the oldest, and while it's diversified, is has very, very small number of constituent members. When you look at and consider stock index futures, it's absolutely essential to understand the underlying index itself. In other words, what I would suggest to you today is it's very important for you to understand what makes up the underlying index, to understand how the futures contract will behave. Because the futures contract is going to trade in a very, very high correlation to the index itself, above 99% correlation. But that doesn't mean anything if you don't understand what goes into the constituent members of the index itself. So when we look at all of the 3 indexes we're going to consider today, the Dow Jones Industrial Average futures, the S&P 500 futures, and the Nasdaq 100 futures, we're going to spend some time looking at what makes up the actual underlying index, because then you'll have a greater understanding of what drives the index itself, which in turn drives the pricing of the futures contract. Let's first consider the Dow Jones futures contract. The Dow, as I said, is very old. The index itself was created at the end of the 19th century. What is important for you to understand is it's made up of 30 blue chip companies from the US, very large companies, large cap companies, but it's known as what's known as a price weighted index or a price weighted average. So it's based on the price movements of the underlying 30 companies that make up the index. If you look at the pie chart here on the screen, you can see obviously very well diversified amongst various different industries. So it is a diversified index, very well diversified over those 30 different companies. But I also would point out, if you look at the top 10 holdings, those top 10 holdings, even though they're diversified, represent 54% of the index value. It doesn't take much, in other words, for any of these large participants for a change in their price to have an impact on the change of the index itself. For example, just this last week, earnings reports on both 3M, McDonald's, Caterpillar, and then just yesterday, Boeing, had significant impacts on the effect of the pricing of the Dow Jones Industrial Average, and then therefore how the futures on the Dow trade. So having a better understanding of these constituent members and how they trade affects the index itself. Now let's consider the broader-based S&P 500. Just by its name, you can tell it's a broader index. The S&P 500 is a broad-based index made up of at least 500 companies. I think the current computation takes in shares of 505 individual U.S. companies. Again, these are mostly large cap companies. But unlike the Dow Jones, and here's a chart of the S&P up until, obviously it doesn't take into account the last couple of days, we've actually taken a tumble from the top of roughly 10% over the last couple of weeks. So significant sell-off, a retracement down here to roughly 2650. This is by far and away the biggest index. And as I mentioned in my introductory remarks, when professional managers consider the U.S. stock market or talk about the U.S. stock market, they're generally referring to it in terms of the S&P 500. Because of the amount of assets that are directly benchmarked to the S&P 500, it is by far and away the professional index and the professional benchmark. They take in, these 500 plus companies take in approximately 80% of the total market capitalization of all U.S. stocks. So it's a huge index. It is also very broad-based. As you can see here, there are now 11 sub-indices or sectors that make up the S&P 500. It's very well diversified. And now when you consider its index is what's known as a capitalization-weighted index. In other words, instead of basing the value of the index on price, it's taking into account the prices of those shares, but it is taking them into consideration based on their total market capitalization and not just the price alone. So because it's a bigger index, the top 10 holdings represent a smaller share of the total index. In this case, only 21% as opposed to 54% in the Dow Jones Industrial Average. That makes a significant difference. In other words, the individual pieces of the S&P 500, no matter how big the companies are, have those individual constituent members have less of an impact on the index itself, which makes it a broader-based index for the professional manager who is, by definition, holding more and more companies because of their diversification. The last index we want to consider is the Nasdaq 100. This is a relatively young index compared to the other two. It was the original electronic trading platform for U.S. equities. Nasdaq stands for the National Association of Securities Dealers Automated Quotation System. That's a long-winded, it's much easier to say Nasdaq. And Nasdaq was the original electronic market. These were stocks that were listed electronically in the early 1970s, and this has become a much more broader and accepted index. as you can see, again, reviewing all of our indices on a long-term basis, it's been a positively growth uptrend over the last several years, and it generally is in stock index futures or in stocks themselves. But when we consider the Nasdaq 100, now look at this pie chart. You can see a lot less diversification. What you're seeing here is a concentration by industry class or by sector. And it's important to note that this is a part of the definition of the index itself. The Nasdaq 100, by its definition, is made up of the 100 non-financial companies listed on the Nasdaq stock market. So it tends to be more heavily weighted towards technology. If you look at the top 10 holdings of the Nasdaq 100, you can see almost every one of them. If they're not a tech company outright, they're in the tech or communications field. And again, the top 10 holdings now represent more than 50%, in this case 56% of the total index. So changes in the prices of these top 10 holdings, which are the techs, have a significantly bigger impact on the index itself. So when I consider the Nasdaq 100 index, I look at this big, huge blue portion, which represents the technology sector. I consider the Nasdaq 100 to be almost a tech index by itself. And we're going to consider that in a few minutes when we look at the indexes against each other. Okay, now let's consider some of the mechanics of the futures contracts as they relate to the spot indexes themselves. All of these contracts trade versus the index and will ultimately, as you know, futures contracts aren't assets. They convey no rights of ownership. So when you buy an S&P 500 future, you don't own anything. It's basically a price point in time. And some point in time in the future, and in futures contracts, that's defined as the final expiration date, that futures contract will expire and it will die as an instrument. So in order to maintain an ongoing financial position in futures, you have to roll your positions forward. Now, there are three ways a futures contract can be concluded. It can be offset with an opposite position. In other words, if you're long one contract and you sell one contract, your position is flat. You've offset that position. You no longer have any risk in that marketplace. You can go all the way to expiration, and at which point the contract dies its natural death. It settles to the cash index, and on the last day of trading and its settlement, there's an exchange of cash in your futures account to the final settlement price, and then the futures position is flattened and dead. Or you roll that position forward in the effect of creating what is known as a calendar spread or a roll by offsetting your existing position in the front month and creating a new position in the next deferred quarterly contract month. All three of those are ways in which a futures contract can be settled. On a daily basis, these futures contracts are marked to market in the last 30 seconds of trade between 3:15 and 14 minutes and 30 seconds and 3:15 even Chicago time. At the end of a contract's life cycle, they settle to something that's known as the special opening quotation. And we're going to get an example of this. All three indices that we're considering today, the Dow Jones, the S&P, and the Nasdaq, have as their final settlement a settlement to what's known as this SOQ, or special opening quotation. That special opening quotation is a calculation that's made by the index providers. So it's made by Dow Jones, S&P, it's made by the S&P Corporation and the Nasdaq. On the last day of trading, and they do this every day, by the way, they will take the actual opening price of all of the constituent numbers of that particular index, and based on the first trade, or the opening price for that stock, they will take all of those constituent numbers and calculate, according to their index formula, a special opening quotation index value. that SOQ on the last day of trading becomes the final settlement price for the contract. So what's important for you to understand here, and why this is important for you, because most of you will probably never go all the way to expiration, is that the cash and the futures settle to the same index value on the last day of trading. And this is important because it's this phenomena, the final convergence of futures to cash, that imposes the pricing integrity on the futures contract. In other words, if the futures price were ever to deviate by a large degree from the underlying value of the index, some smart people would come in and spread whichever, if the futures got too rich or were trading above the index by too large an amount, they would sell the futures and buy the spot index. And by virtue of this convergence, could take it all the way into expiration and get that spread out by last trading day. If the futures contract were ever to cheapen by too great a degree, they would simply buy the futures contract and sell the spot index. And if they had to, take it all the way into expiration and take out that spread at a profit. Because the futures and the cash settle to the same value at expiration, that convergence imposes the pricing integrity on the contracts. That's one of the reasons why these futures contracts trade so heavily, is that market practitioners know that the pricing integrity is genuine because spreaders will keep it so. So here's an example. On June 15th, when the S&P futures contracts stopped trading, the SOQ on that day was calculated by Standard & Poor's at 2776.85 index points. That was the final settlement price for our E-mini and our big S&P futures contracts. So at that point in time, any positions that were open in the June contract from the previous day were marked to a final price of 2776.85. And if the losers paid the winners, the contract expired and died, and a new S&P 500 contract was listed 5 quarters out. So that's how the process operates. You can see our total equity index complex trades rather heavily. This doesn't go back to 2005 and 2007, but what you'll see is the lighter blue lines here show volume. The darker blue tips at the top show you options on equity index futures, and the green line shows open interest. What you're looking at here is average daily trading volume chopping around at a pretty good average. But I would point out you can see the darker blue tips growing in participation as you approach current levels, and especially out here in the first quarter of this year. Notice the increase in options on equity index futures. This is the fastest growing portion of our business in equity index products. It's the options on the futures contracts. And I'm going to take a moment here to point out that if you consider options from CME Group, remember that any options that are traded by CME always have as their underlying a futures contract position, not the index itself. Now, secondarily, most of the activity, when you see big spikes of trading activity, this is generally when the market is experiencing sell-offs. Back in late 2010, there was a scare in the U.S. stock market. That accounts for this spike here. And then this first quarter spike refers to that volatility spike we had late January, early February of this year. And if we were to extend this out with data over the last several weeks, I would say with a very high level of confidence, you would see a very big increase in trading volumes. That's because people trade index futures for a lot of reasons, but they tend to trade them most frequently and most actively when the cash market is selling off. Okay, who uses these contracts and why? This is going to be very important to you because it's important to know who may be moving the market around and why. For traders, and a lot of you that are trading already, you already know this, but for those of you that may be new to the trading business, liquidity is everything to a trader or to a risk manager. And what liquidity measures is trading activity. And why that's important to both risk managers and traders is because when you want to get into a trade, sometimes it seems very easy. But what becomes more important sometimes is being able to get out of a trade. And having deep pools of actionable liquidity is essential to being able to move in and out of a contract. What you're looking at on this chart shows you 3 different measures of liquidity. The blue line in the middle shows you the total average daily liquidity in notional terms of all the U.S. stock markets that trade the S&P 500 stocks. So of all of the U.S. stock markets that list S&P 500 shares, that's represented here on an average daily basis by the blue column. The yellow box over here, or the yellow column, represents the average daily trading in notional terms of the largest S&P 500 ETF. This would be the State Street Global Investors SP Spider, or SPY as its trading symbol, ETF. It's the largest ETF that measures the S&P 500. And you can see it's considerably less than what's traded in total on the US stock market. But now let's consider the red column. The red column represents the average daily trading volume in notional terms of just the E-mini S&P 500 futures contracts on CME. What I want you to consider here is this is obviously it's the tallest of the 3, which means it trades the most in terms of its notional. But what this is telling you is that the E-mini S&P futures contracts at CME trade more than 100% of the total volume on the stock market in the underlying shares, and almost 10 times as much as the biggest ETF on the S&P 500. So if you're looking for liquidity, the liquidity is in the S&P 500 futures. The other consideration here is that while these markets, both the blue and the gold, are only open during U.S. trading hours, the red line, or the red column representing E-mini S&P futures, are open 23 hours a day, beginning at 5 p.m. Chicago time and trading through your day session to 4 p.m. the following day Chicago time. So when you need access to the market, like most risk managers do today because of the volatility and event risk that could occur at any time in a 24-hour day, this is the market that is open and the most deeply liquid. Liquidity is a very, very important part of any trader's profile. Let's also look at the different types of users. This chart shows you data that as CME clearing is legally required to report to our federal regulator. We're regulated by what's known as the Commodity Futures Trading Commission, which is in shorthand here, CFTC. The CFTC asks us to give them the data on who holds open positions on all of our futures contracts. They want to know this data because they want to report it to the public, because as a publicly trading exchange, the public has a right to know who holds open positions. Now, the CFTC is not interested in the account names, but what they do want us to do is break those market participants into categories. And in financial futures, they ask us to designate them by one of 4 designations. Those accounts could be either dealer intermediaries, which are referred to in the U.S. as sell-side firms. These are companies like banks, interdealer brokers that are doing business on behalf of other people. The second group are asset managers, or what are sometimes referred to as institutional accounts. These would be buy-side firms, pension funds, mutual funds, insurance portfolios, endowments, what are sometimes referred to as real money accounts. And then the third group are leverage funds. These would be hedge funds, commodity trading advisors, or proprietary trading outfits that are trading for their own accounts. And then the last is just large holders that may not fit into those other three buckets. So with that information in hand, the CFTC creates what's known as the Commitment of Traders Report, the COT report. And this is released every week on Monday and is available for the public to see on the CFTC's website. There's also a version of it available on CME Group's website as well. All I've done here is take the data for the S&P 500 E-mini futures and dump them into an Excel spreadsheet to create this table, or this chart. And the chart is, again, kind of showing you the same data, but represented in the ways that it's reported by the CFTC. The blue line represents net long positions, the red columns represent net short positions, and the green lines represent spread positions. Now, what this is telling us with respect to E-mini S&P 500 futures, for example, is that the asset manager institutionals are the largest participants in open interest in this particular contract. You'll see that there are participants from all of the four main reporting classes: dealer intermediaries, asset managers, leverage funds, and others, and that they participate both from the long and the short side. But the asset managers, or the buy-side firms, are particularly involved in the equity index products, and there's a reason for that, and we're going to go into that in just a minute. But notice how they're both long as well as short. Same with the dealer intermediaries, both long but especially short. Leverage funds are both long and short. Asset managers tend to be predominantly long equity index products for a specific and particular reason, as we're going to see in a few minutes. That may or may not be important to you as a trader, but it's important information for you to know and understand, because it will help you understand a little bit more about what helps move this market around. Now we're going to consider the actual mechanics. What goes into the price you see when you look at it on your trading screen? You're probably familiar with the fact that equity index futures trade in what are known as index points. Well, each contract has its own index that it tracks, so it tracks it based on its index points. But the index points themselves are made up of a couple of things that we're going to see in just a few minutes. The first thing we want to consider is what's known as the financial or the notional value of the futures contract. In other words, I mentioned previously that futures contracts are not assets, but they replicate assets. And in order to consider what the financial value or the theoretical financial value of the futures contract is, you have to have a couple of inputs. First of all, you need the index value itself. And in this table, this is the S&P E-minis from the middle of June, you'll see listed the 5 quarterly contracts that are listed at any one time. Taking the settlement price from the June contract, 2784.00, the S&P has a fixed multiplier of $50 per contract. So and you're going to see the Dow Jones has its own multiplier, the Nasdaq 100 has its own multiplier. The E-mini S&P has a $50 multiplier. So you take the multiplier, which is a fixed number, times the quoted value of the index, which is a variable number. This is changing all the time. You arrive at the financial value or the notional value of the contract. In this exercise, you can see it's $139,200 per contract. Now, obviously, if this number gets higher, so will the notional value. If this number drops in value, so will the notional value. Another important feature about equity index futures to be aware of is that the volume and the open interest tends to stay in the front quarterly contract until just before that contract expires. Again, this is a snapshot from June, which was just a week before contract expiration. And you'll notice that there's activity in both the June and the September futures contract, to the degree that you've got about 50-50 split in open interest, because the roll from the quarterly contract to the next quarterly contract has just begun. Once this roll is completed, the concentration will be in the September, and will stay that way until about the second week of September. and then roll into the December and so forth and so on. So very small percentage of the open interest goes all the way to expiration, and the concentration tends to stay in what is the front quarterly contract until then. Now let's look at the prices themselves. If you look at this table, you'll discern a very easily observable thing about equity index futures relative to time. Notice as you go forward in time, June 18, SEP 18, DECE 18, March 19, June 19, the value of the index futures themselves are getting higher the further you go out in time. There's a reason for that. There's a financial reason for that. There's a mathematical reason for that. And it's expressed in what drives what's known as the fair value of the futures contract. The futures contract derives its value from whatever the spot index is of the underlying, and this combination of the financial cost versus the dividend income stream. In other words, if I were to replicate the index using the futures contract, I would be using leveraged money in the terms of borrowing funds versus the dividend stream. This difference affects the price of the index versus its underlying. Excuse me. For example, over the last, let's say, 10 years, after the great financial crisis, when our central bank, like many central banks around the world, pushed short-term interest rates to practically zero, or in some cases, like in Europe and in Japan, actually below zero, the dividend stream on equities was much greater than the financing cost, which resulted in a phenomenon known as positive carry. Positive carry meant that by owning the index, you were participating in a dividend stream that was greater than your cost of financing, creating what's known as positive carry. Well, as I've said, the futures contract's not an asset. And since it doesn't convey any rights of ownership, the futures contract that trades like the stock index futures has to account for that positive income stream. And because the only way it can is through discounting, in a positive carry environment, futures contracts over time will trade at a discount. But what's happened in the last 3 years, since our central bank began to raise interest rates, those short-term financing costs have risen and are now higher than the dividend stream. And that's resulted in what's known as negative carry. And because the short-term interest rates are now greater than the dividend stream, and by the way, that dividend income stream as measured in yield terms is roughly 2% for the S&P 500. So short-term rates are now about 2.5%. The dividend income stream is probably around 2%. So there's what's known as negative carry. And that's why that futures contract now has to trade at a premium over time rather than a discount. And that's a result of short-term interest rates now rising above short-term, the dividend stream created by the cash instruments itself. In the end, it doesn't make any difference whether there's positive or negative carry. The time value, as it gets closer to expiration, converges to spot. So ultimately, the futures contract, which as you can see by this illustration, has an extremely high correlation to the underlying index, will converge to that SOQ number at expiration. That does two things. It assures you of the pricing integrity of the futures contract to the spot index itself, and the mathematical valuation of that difference, that basis between cash and futures, can be measured and can be traded if you have access to both the cash and the futures products. Referring back to the large institutional users, remember in that commitment of traders slide, that large blue category, they're using these contracts very, very strategically to do what's known as replicating beta. In other words, a large asset manager like a mutual fund or a pension fund that has exposure to the S&P 500 also has to, by virtue of their business and operational activities, has at any given point in time they have cash in their positions. And if that cash is just sitting there as cash, it creates a drag on the overall portfolio that's benchmarked to the S&P 500. In order to be able to be fully invested, they would have to constantly be putting that cash to work by buying shares in the S&P 500, for example. Well, that can become a very costly, very expensive process. It also could mean if they need the cash, like if I'm operating a mutual fund and I get redemptions, like I'm probably getting this week, I have to pay those redemptions out in cash. What these larger funds that are indexed to an index like the S&P do is they use the E-mini S&P futures to replicate their core positions. In other words, because the futures don't require 100% payment like the cash instruments do, they can be used in a leveraged capacity to create a cash-like position. This is known as passive indexing, and it is the basis for that very large blue column in the Commitment of Traders reports. Large asset managers use the futures contracts to create what are synthetically long cash positions. And because they only have to put up the performance bond or the initial margin on the futures contract rather than the 100% of the underlying, they can retain cash for operational purposes but be 100% invested from a benchmark performance standpoint. This allows them to be more true to their true benchmark but retain cash for operational purposes. That same argument, beta replication, can be extended further out this spectrum to things like portable alpha, where they can use the residual cash and invest in risk-free interest rate products to create additional income for the fund. They can use it for other more actively managed strategies, and those strategies can be very low in terms of risk. They can be very great in terms of risk, depending on the investment guidelines of that particular manager. So these futures contracts are used by the professional trader, the professional risk manager, in many, many ways, a lot of those ways from the long side to replicate performance of the underlying instrument. The last thing I want us to consider today is that while these indexes trade individually by index and by index futures, they can also be spread against each other. A spread trade, as you're probably aware, is very common in the futures industry. It's where you simultaneously take a long and a short position in what are usually highly correlated products. The idea behind a spread trade isn't necessarily to take advantage of the directional activity, but the relative value or the relative difference between the two products that you're spreading. For example, corn and wheat are both grains. They tend to trade in a highly correlated manner. It's very common to spread corn against wheat if you're comparing the relative difference between those two grains. You can trade spreads in interest rate products to reflect an attitude about the yield curve, for example. Buying 2 years and selling 10-year treasuries is an example of a spread of two highly correlated interest rate products, but the difference between the two would represent the relationship between the slope of the yield curve, for example. What I'm going to ask you to consider today is equity index spreads, where you would take a long and an equally short position in two stock indexes with the idea that not that stocks will go up or down, but the relative difference between the indexes themselves might create a potential trading opportunity. And this takes us back to where we started. If you consider the index's constituent members and how those constituents will affect the index value itself, you can perhaps put together a relative value trade. As a way of illustrating this, let's consider the S&P 500 futures versus the Nasdaq 100 futures. Now notice on this chart, the red line represents the Nasdaq 100 futures, The blue line represents the E-mini S&P. Both of these are stock indexes on U.S. companies. Notice the high degree of correlation between the two. The correlation between the two is above 90%. But there's enough of a difference between these two indices and their constituent construction to represent a possible relative value or a spread trade. Let's consider that for a minute. Remember, the S&P 500 is a broad-based, capitalization-weighted index of 500 companies across all 11 sectors of the U.S. marketplace. The Nasdaq 100 is a more concentrated index, focused more greatly on the technology sector. So when, again, as I mentioned earlier, let's think of the Nasdaq as a more of a tech-centered index against the S&P, which is more of a broad-based market index. In this case, let's consider a trader who would like to increase his exposure to technology, or the technology sector of the U.S. stock market, as opposed to the broad-based S&P. Can you do that without assuming directional market risk, but just the relative difference between the tech sector and the broad market? The answer is yes. We do this by creating a spread trade between the Nasdaq 100 futures and the E-mini S&Ps. That spread ratio takes us back to that calculation of the notional value, which is the index times its fixed multiplier. If I divide the notional value of the E-mini S&P into the notional value of the Nasdaq, I can create a spread ratio. And as you can see from the math on this slide, rounded to whole numbers, it's a 1-to-1 spread as of December of 2017. So by buying 10 of the E-mini Nasdaqs of the June contract and selling 10 June E-mini S&Ps on an equal basis, we're basically suggesting that we think the tech sector will outperform the broad market. That's the bias that's implied by buying the Nasdaq and selling the E-mini S&P. Let's see what happens over the course of the first quarter of this last year. On March 1st, we're going to offset this position and consider the results. The blue line in this chart shows you the broad market as represented by the June E-mini S&Ps. It went up, it went down, it chopped around and started to move up again and then sold off. The red line represents the spread relationship between the two. The spread continues to go wider regardless of the market sell-off or the market rally. In other words, it doesn't make any difference to the spread at this particular period of time whether the market was going up or going down. The spread, for the most part, was trending higher or wider. Here's the result of the trade. Over that period from December to March, the broad market, as measured by the S&P 500, was up 1.4%. But the Nasdaq, or the tech sector, as measured by the Nasdaq 100, was up almost 6.5%, a 5% difference between the two. How did the trade perform? Well, you would have expected a positive outcome, and you got one. By being long the Nasdaq, that leg of the spread generated almost $82,000 of profit. There was a subsequent loss in the S&P, but only $18,000. So the net difference was $63,625,000, or the equivalent of a 4.9% return on an equivalent notional amount of $1.3 million. That sounds tremendous and represents the relative difference between those two indices, regardless of the market direction. But here's another reason to consider index spreads. Because CME Clearing looks at these risk positions as a net position, and because of the high level of correlation between the two indices, there's a margin offset of 75%. So instead of having to put up $116,000 on individual spreads, of the legs of these spreads, the spread position would have only required $29,000 of margin. This greatly improves your return on capital use for the trade. In other words, instead of making 4.9% on the equivalent underlying notional of $1.3 million, you would have had a 200+% return on capital use by doing this as a futures spread cleared through one clearinghouse. This is an example of how futures trading can greatly enhance performance if done in spread positions by judicious use of futures for risk management and for trading activity.
So thank you, everyone. So should you have any further queries, please feel free to drop us an email at bcrm@kenanga.com.my. We appreciate you being here and hope you enjoyed the webinar today.